Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, I'm going to be talking about two companies that are very similar, which is GFL Environmental and Waste Connections, two Canadian-based waste management companies. And I'm going to be talking about why I actually decided to invest in GFL over Waste Connections in this video. And I think this will be an interesting video because I can showcase to you guys what my thought process was for distinguishing between two companies that are very similar, that are in the same industry, to decide which one is probably going to end up being the better investment. And then also over the next coming years, we can actually see how this ends up playing out. And we can see if my thesis actually ended up being right in GFL specifically. So without further ado, let's just dive right in. So initially, I was looking to add a new position to my portfolio, which was a company that was more recession resistant in nature. And what I mean by that is a company that doesn't necessarily require a thriving economy to do well. Because I took a look at the other individual holdings in my portfolio and I realized there wasn't very much diversification in that regard. Many of the companies I owned would likely only go up and down with the overall market, and there was no company that was recession resistant and one that was in a very stable and very predictable industry. And I thought that the waste management industry met that criteria very well. And I've also been interested in this industry for quite a long time because I had read about some interesting things going on, such as this very large trend towards consolidation in the industry, where the big players are quickly buying up the smaller, more local operators, and the incumbents in the industry do actually have a lot of pricing power because of this. So one thing I looked at specifically was this chart I put to here, where I'm looking at the revenue growth over the past few quarters that Waste Connections and GFL have both achieved from just simply raising prices on their customers, because this is kind of a signal of one, inflation, but also the pricing power that they have. And it ends up being pretty similar. We can see for many quarters, GFL, which is in the blue here, was raising prices at a higher rate, but that's kind of shifted over the more recent quarters where it's been much more equal, and even Waste Connections was raising prices at a higher rate. But we can see this is consistently been a few percentage points above the rate of inflation. So this does signal that these companies do at least have some pricing power. And the other driver of revenue for them is waste volume, right? The volume of waste that they process, that they deal with. And that, for the most part, is going to be pretty consistent regardless of the economic climate. And that's simply because people produce trash no matter what. And it's an industry that is relatively immune to disruption, right? The barriers you face when you start a waste management company are extremely high, and GFL is really a prime example of that, right? There's a ton of regulation in this industry, and a company like GFL, they required billions of dollars in private equity funding and many, many years of operating just to get to a point where they have a shot at becoming one of the more larger, more established waste management companies in this space. And it was truly something unique that they ended up doing to get to that point. The only real disruption that you would see in the waste management industry would be some new regulation, like an environmental law that gets introduced. But that's the type of thing that management sees that thing coming well in advance, and they can deal with it and they can plan for it. So the whole industry really just reminded me of the types of things that you read about when you read value investing books, where they say invest in simple and predictable businesses that you can forecast 5 years out into the future with a high degree of confidence. So I think the waste management industry is very attractive in that regard. Okay, so let's now talk about the key differences between GFL Environmental and Waste Connections. Now, I won't go too in depth on GFL because I covered them in a past video extensively, and I'll put a card on the screen now for those who want to go and watch that video. But for Waste Connections, they are a much larger company and they focus more on rural areas, managing waste in more rural areas, as opposed to GFL, which operates in both rural areas but more so in urbanized areas. So naturally, Waste Connections does have less competition when they're bidding on new contracts, and these tend to be longer term contracts than what GFL is going to have. And Waste Connections also has a significantly less diversified service offering than GFL does. Mainly what they do is just solid waste management, like the collection, transfer, disposal, and recycling process. And these 2 points are important because it means Waste Connections is probably always going to have higher operating margins than GFL. GFL is still kind of in this growth phase, but what you're probably going to see even when GFL a few years down the future, once they're a profitable company, because GFL still isn't actually profitable or even free cash flow positive yet, once they kind of hit that mature phase, they're still probably going to be a little bit less profitable overall than Waste Connections. It doesn't necessarily mean they're a worse company. It just means they're going to be a bit less profitable. And it's the reason is for those two reasons I just described. So what I'm looking at here is kind of the three key cost drivers for Waste Connections as a percentage of revenue, right? So the blue line's cost of goods sold. The orange and gray lines is selling general and admin, and then depreciation amortization. We can see this has been essentially the same going back almost 8 years now. So Waste Connections has been a very, very consistent company over the years, and investors have really come to appreciate that consistency that they have given them, and they kind of valued at a premium because of that, because everyone knows what to expect with this company now. But there hasn't really been any, cost synergies or operating efficiencies they've gained because, as we can see clearly here, their cost items relative to their revenue haven't really moved. Whereas we go to GFL, again, they're still kind of in the growth phase, but you're seeing this general downward trend where their cost items as a percentage of the revenue are going down and down each year with a bit of fluctuation. This one, selling general and admin, is pretty stable, but depreciation amortization has come down significantly from 30% of revenue now down below 20%. And even cost of goods sold, as we can see here, is going down by about 1% per year. So this is kind of where GFL is at. They're looking to get to a point where they are more comparable in terms of profitability to Waste Connections, but they're a younger company. They're still a growing company. They're pursuing a slightly different strategy as well. So they are going to be a little bit different. But really, the key differences between them is GFL is taking a more aggressive acquisition based strategy with a more diversified service offering that includes things like soil remediation, industrial waste management, liquid waste management, those kinds of things, and they have more operations in urbanized areas. Whereas Waste Connections still does acquisitions, but it's relatively a smaller amount compared to GFL, and they do tend to focus more on rural markets where there's less competition and a more focused, less diversified service offering to their customers. So now I'll talk about the reasons why I chose GFL specifically. So the main reason why I chose GFL is because they have a lot more debt than Waste Connections does. Now, you may be thinking, well, wait a second, how does that make any sense? You're saying you're buying a company specifically because they have higher debt? And yes, I am. And the reason for that is because that debt is likely to be reduced in the coming years, and it's the main reason why GFL is valued at a pretty steep discount relative to an industry peer like Waste Connections. So if we look here in this chart that I put together here, which by the way I created using my website, which is called tickernomics.com. This is a website that's currently free to use. So if you are interested in using it, link is in the description of this video. But we can see here that GFL is valued on an enterprise value to EBITDA basis of about 14.3, whereas Waste Connections is much higher at just over 20. And GFL does also have a higher leverage ratio, which goes into the debt part I was talking about. So GFL's leverage ratio, which is just net debt to EBITDA, is about 5.5, whereas Waste Connections is considerably lower at about 3.3. And not only that, but GFL is also free cash flow negative. They aren't currently producing a profit, and their operating margins are significantly lower. And they're also just in general a smaller company that doesn't really have the track record that a larger company, a more established company like Waste Connections have. And investors certainly do value stability and predictability and tend to assign companies a little bit of a premium that have that proven quality. So GFL's debt is much higher because they're pursuing this very aggressive acquisition strategy. If we go to their GFL's most recent MD&A, we can see since 2007 when they were created, they've completed over 260 acquisitions. They're generally completing about 10 new acquisitions every quarter. And this is a high risk strategy because if management can't control costs and eventually get to profitability, then the company just simply won't do well. And you added now the fact that interest rates are a lot higher than they were, say, 2, 3 years ago. And obviously, from that, their interest costs have gone up a lot, which is going to reduce profitability. But this leverage ratio that we're looking at here has been coming down and down each year. For example, if we take a look at what it's been kind of over the years, if we go to the charts feature here. So what I want to do here is I want to take Waste Connections net debt to EBITDA ratio and then just compare this to what it currently is for GFL. So we'll put this here and then we'll see what it is for GFL. So GFL's is obviously going to be much higher, and what you're going to see with Waste Connections is it's been very stable over the years, right? So Waste Connections here in the green has been very stable, whereas GFL is still higher, but it was much higher if you go back into 2020. So it's been coming down. It's been coming down because they've been paying down their debt for one, and also because EBITDA is growing, right? So it's kind of changing how that gets calculated. So, and then also with GFL, the company, like I just showed you, is becoming more and more operationally efficient each year, right? As I just showed you, all these cost items relative to revenue are consistently coming down and down each year. But basically, as long as this risk factor exists with GFL, the fact that they have this higher debt load, which is now more risky because interest rates have gone up, investors just simply cannot value them the same way they would with other waste management companies that have less debt, that are more mature, with better margins. So as long as that risk with GFL exists, then they're always going to look cheap relative to a company like Waste Connections. But like I said before, GFL is actively making that risk less and less of a concern. So in a few years, if their debt is more on par with what it is for peer companies like Waste Connections, and they're still growing at a high rate, and their cost categories as a percentage of revenue continue to go down each year, then there's really no reason to value them at the discount anymore. And this overall concept is actually a fairly common thing to look at in investing, which is just simply finding companies that are being punished for having too much debt on their balance sheet and essentially just waiting for that debt to get reduced. But normally, if you're pursuing a strategy like that, the risk you face is, can the company actually consistently grow to make that debt load look more and more manageable each year until it gets to a point where investors don't believe it's a concern anymore and the valuation premium goes up a bit because now that perceived risk no longer exists. But with an industry like the waste management industry, like we already talked about, it's very stable, it's very predictable, it's recession resistant, so it's very well suited for this style of investing. Okay, so now I actually want to show you some real numbers behind this decision I made to invest in GFL as opposed to Waste Connection. So what I'm showing you here is the same DCF model that I showed in my past video that I did on GFL. And the main takeaway is from this is I have them worth about $64 per share, where they're currently worth in Canadian dollars in the low 40s per share. So clearly this company is undervalued based on my opinion of them. So let's compare that now to Waste Connection. So for this, I'm actually going to use the value of stock feature in my website here. This basically does a discounted cash flow for any company that you enter. So I'll just enter Waste Connections here and it will load some data on this company. And we can change our assumptions here to see, approximately what is this company worth. So the default here is basically the 5-year average for revenue growth. So for the revenue growth assumption, again, because this is a very stable industry, right? The revenue growth is driven by price increases, which are usually 6 or 8% per year, and then a little bit of volume growth, about 1 or 2% per year. And then that growth is also driven by acquisitions that they make. So I'll just leave the revenue growth exactly the same at what it's been over the past few years. Their margins have expanded a little bit, so I'll change this to 17.5%. The tax rate, I'll leave the same, and I'm just going to adjust things like these capital expenditures and depreciation to something that's more reasonable with what it's been in the more recent years. I'll change the cash balance to what it is currently. And then the last assumption I want to change is the actual terminal multiple, right? So this is again the EV/EBITDA multiple. And we can see what it's like for other companies. So Waste Connections, the company we're valuing here, EV/EBITDA of about 20. And then we can see another company like GFL where it's kind of in the 14 range. So overall, I mean, the average here is about 10 and the median is about 14. So Waste Connections is valued a little bit more steeply, but the reason they're valued more steeply is because investors have come to appreciate kind of the quality of their business overall and the consistency that we've seen from it. So I'll put this to something like 18, right? And then I'll leave the discount rate the same and I'll just click calculate DCF. And basically what I wanted to show you here is this company is pretty much fairly valued, right? We get an intrinsic value under what these assumptions I think are fair and reasonable assumptions. These aren't overly conservative. They aren't super aggressive either. But basically this company is approximately fairly valued, right? Intrinsic value of about 178, where their current price per share is 164. And this is all in US dollars, by the way. So, for example, let's say if they do their revenue growth a little bit slower than what it's been over the past 5 years, and say it's 8%, right? Because, maybe it's just difficult to raise the prices if inflation kind of isn't as high as what it was in 2022 and 2023. So maybe revenue growth is a little bit lower. Now they're pretty much bang on fairly valued, right? So you can kind of understand my thought process here, right? Where I just simply think that GFL is the more undervalued company. And because they are a newer company, they're kind of in this growth phase. If my goal is to kind of just be invested in the waste management sector because it has those attractive qualities for an investor that I talked about at the beginning of this video, I'm going to pick the company that I believe to be more undervalued, which is probably the company that there's going to be more disagreements amongst investors about what that company is worth because there's more questions about how they're going to perform in the future, which in this case, that seems to be GFL. And even if it takes GFL 4 or 5 years to get to a point where their margins and their debt level is more comparable to Waste Connections, then at that point they should be valued more similarly to Waste Connections because that whole execution risk of their very aggressive strategy that involves them taking on more debt won't look like as big of a risk anymore. So essentially with GFL, what you get that's going to drive your returns in a investment in that company is going to be number one, the growth of the business. Number two, their operating margins getting bigger every year, plus some multiple expansion when investors start to value them more like they value the other large waste management companies. Whereas if you're invested in a company like Waste Connections, which I believe is only fairly valued at its current price, really the only drive of your returns is going to be the overall growth in the business. Maybe there's some slight margin expansion in their operating margins, but as we saw historically, their operating margins really haven't moved over the past 8 or so years. And if we look at their valuation multiple, it's already pretty stretched. It's already pretty much the highest in the entire industry. So that really isn't going to be a driver of your returns. So that's my thoughts, guys. I hope you did enjoy this video and you found it insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you consider subscribing. And I'll see you guys in the next video.